iPhone, please could you announce yourself?
Hi, whoever's named iPhone, while it's a fantastic name, could you let us know who you are, please?
Oh, this is Mike. It's Mike Fastenal. I already introduced myself, but I'm realizing I called in from an iPhone, so that's probably me.
There's actually someone else named iPhone.
Yeah, this is Alexandra Shive from McDermott. It might be mine.
How are you?
I'm good, thank you. How are you, Ron?
I'm doing well, thank you. Let's start admitting people.
Hi, Cindy. Hi, Wendy.
Hey, good morning, everyone.
Good morning.
Hi,
Starting
Cindy.
with
Good morning.
One of my favorite people, David.
Good morning. How's everybody doing today?
You're gonna have fun with Ajit. I'm sure you're gonna you guys are gonna juggle and chime and create more controversies.
Oh, it's the summer, Sonia.
Let me turn down the volume here.
All right, we've got folks piling in now, Sonia. I'll kick off with your permission. If anyone's on, Ed, I'm going to have to mute you. Apologies. So I'm going to kick off. A very good day, all. Welcome to the Wall Street Blockchain Alliance's Enterprise and Technology Monthly Working Group meeting. As per all of our meetings, this is subject to both our confidentiality and antitrust policies. So play nice, no price collusions, ask interesting questions. Meeting protocol, speakers, if you're speaking, especially if you're on a phone, please identify yourselves before speaking. And our standing Zoom protocol is if in the rare instance we get Zoom bombed, which hasn't happened in over 18 months, then we will end the call immediately. But otherwise, looking forward to a great presentation. Sonia, the chair of our working group, I turn it over to you.
So guys, we're actually very lucky to have Ajit here. I've known Ajit for, I think, 5 years probably. He's one of the first few people. I met him at a consensus event, and then we've chatted, we've tried to work together. He's one of the forerunners in this industry, not just, he only believed in blockchain earlier, and now he believes in the token world. It took him a while to get into that space. And coming from the market risk side and the derivative side, I think he adds a very different perspective to this whole staking ecosystem and the whole DeFi ecosystem. And we want to have a controversial conversation here. We're kind of looking at David, Garrett, and other people to kind of challenge Ajit, and it's going to be fun. And Ajit can be challenged. So please challenge him, and you're going to have fun working. I mean, he has some revolutionary ideas. He started actually investing a lot of startups in India and sits on a couple of boards, very famous in the London blockchain ecosystem. Heard a lot of his presentations and actually followed him in many ways, learned a lot from his articles that he's written. So you guys are very extremely lucky to have him here today. So please make the most of it and challenge him.
Absolutely, thank you. So yeah, so you're extremely lucky. I assure you, you're extremely lucky. I'm joking. So anyways, thank you, Sonia, for that wonderful introduction, right? I mean, my wife has no idea how lucky she is, but we're not going to go there. So anyways, so yeah, so just for intros, I work for Aave. I focus on, institutional growth and policy engagement, along with Rebecca Rettig, who is our general counsel and a member of this group. But I managed to keep her out of this discussion so that I can speak freely. So I didn't bring our general counsel to the meeting, since I could speak more freely. Anyways, so yes, so Aave is the word, hey, Anne-Sophie, I see you again. So I think I know some of the people because I've been in space, Donna, good to see you. I think I just said something about GC, and Donna knows Rebecca really well, so I'll take that back. So yeah, so I've been in the crypto and blockchain space for over five years. Yeah, I spent the first part of my blockchain career focusing on enterprise blockchain, essentially a lot of financial infrastructure, trade finance, market infrastructure type projects, and some of the biggest in the space. And then one of the things I realized after doing that for 3 years is that not a lot was getting done. Whereas, in the public blockchain and crypto space, we were getting an awful lot done in terms of innovation, in terms of new infrastructure, in terms of new technology, and so on. So I sort of shifted over to crypto and was very fortunate to get the opportunity to be at the bleeding edge of DeFi and then continue to build bridges between crypto and market infrastructure. So and let's make this interactive. I'll have a PowerPoint, but we can share that later, or especially in corporate America and Europe, we sit through so many PowerPoints that I've gracefully decided to spare you that. And we're gonna try and do a demo. Can I share my screen?
You should be able to share your screen, Ajit.
Okay, great. So yeah, so we'll keep it interactive and more hands-on, and which is kind of the the way DeFi works as well. So Aave is currently the world's leading decentralized liquidity protocol in terms of the total size of assets. So we had a maximum of 21.3 billion in liquidity, and I think since then the markets have corrected significantly. We currently have 16.4 billion in deposits across the various liquidity pools in Aave. I'll explain what that means. And it's quite a simple user interface. I think one of the things to notice is how far we have come in terms of crypto UX, and how starting in 2015 with Ethereum, it used to be really clunky. Now it feels like any other fintech application, right? So if you look at what Aave does, then it's basically a protocol for depositing and borrowing crypto assets and stable coins. And the way you're interacting with it is, you're borrowing from a smart contract and you're depositing into a smart contract, right? It's really that simple. So currently there is about 4 billion in stablecoin USDC liquidity. People have deposited this amount, and the total borrowed is approximately 2.75 billion. So and depending on the demand and supply for a particular asset in this liquidity pool, and there are 3 pools here. There is a V2 pool, an Amm pool, a market as we call it, and the Aave Polygon market. So in the V2 pool, you can see that 2.75 billion have been borrowed out of the 4 billion liquidity, which kind of sets the interest rates automatically. So unlike some of the centralized crypto lending intermediaries with the Aave protocol, there is no manual operation. You don't have people sort of trading or doing the GBTC Bitcoin ARB to deliver a yield. It's essentially like a clearing system, right? So with DeFi in general, what you're seeing is what Ray Dalio said. A clearing system on the internet, and that's true not just for Aave, but also for the AMMs like Uniswap, and we can discuss why that is. So Aave, the front end, the website that is currently owned by the one of the Aave companies, is just one of the interfaces to the Aave protocol. There are multiple wallets, like you can connect using Coinbase wallet, using MetaMask, using a variety of some fintech apps like Everest, and increasingly more different DeFi protocols like Yearn and so on and so forth. So there are quite a few DeFi, Rari Capital, Yearn, so on. So there are lots of DeFi protocols, Ohm, Olympus, and so on that interact with Aave as well in the background. So that interaction of DeFi protocols is a key idea. If I had to take notes, I would say composability is kind of critical to DeFi infrastructure, as in the ability to construct financial applications using smart contracts that people have deployed in an open source environment. So what makes DeFi in our book? I mean, in our opinion, the first thing is the open source nature, as in the source code for Aave is available on GitHub, and it's free for everyone to use. There is no it's royalty free. Whoever wants to use it can use it. Integration is straightforward. You don't need to come to Aave and ask me or anyone, Stani or anyone anything. You can just connect to the Solidity code or using the JavaScript API and essentially build whatever you want to build. So there is which drives a lot of innovation in this ecosystem, because it's permissionless, as in people can connect and build, innovate rapidly and freely, as opposed to in the enterprise where I used to sit through days of meetings, PowerPoint, endless working groups, and there is a place for that too, but I think I got a little bit it wasn't going anywhere. So I think DeFi is open source, permissionless innovation driven by engineers and product people for the most part. And it's a little bit, and that's why it's important to understand DeFi from the perspectives of internet history as opposed to financial services. And we'll talk more about that in a few minutes. But what we are looking at is internet first, decentralized, and decentralization is a loaded word. We'll talk about what that means in our book, and the market infrastructure that's being created by developers on public permissionless blockchains. So, public permissionless blockchains, open source, and this idea that, anyone can contribute, and protocols or systems are controlled not by, a bank or a corporate entity, but by, token holders. And we'll talk about that. So anyway, so what does this look like? Yeah, connect your wallet. So this version of Aave protocol is permissionless. So anyone can connect with a simple MetaMask wallet or Wallet Connect or Coinbase wallet. So if you, all right, I'm on Girly. That's why. So Ethereum mainnet. If I just go here, and then I say, all right, let's connect. Then,
Ajit,
okay.
Ajit, 1 minute. So, can you explain the AMM portion a little more before we move on?
Yeah, we'll go there. So I want to come to that next, right? So right now, I have some crypto assets in my wallet, and so I can deposit. Let's say, if I want to deposit, another 20,000 here, then I can deposit, and I can see, what sort of gas fees I'm looking at. On Ethereum, every transaction costs some money, and then so what sort of interest I'm going to earn on this deposit, and it's approximately 2%. Then you see some risk parameters here. You see that how much of the available liquidity in the pool has been utilized. Approximately 70% has been utilized. You see how much the LTV is going to be on this asset. So if I deposit, $100 worth of USDC, then I can borrow up to $80 worth of USDC. So each asset, if it's essentially acceptable collateral, because this is a permissionless environment where the identities of the participants are not known, everyone is connecting using a MetaMask wallet and an Ethereum address. So there is no credit mitigation apart from collateral. The only thing you can rely on is a haircut on the collateral the participants are posting. So you deposit $100 and you can borrow up to $80. Now, liquidation threshold is 85%. That's another risk parameter. So liquidation is a key concept, meaning if I deposit $100 worth of Bitcoin, let's say, and borrow $80 worth of USDC, right? Deposit $100 worth of Bitcoin, borrow $80 worth of USDC. Then if Bitcoin drops in price 10% or 20% and becomes, let's say $90 worth, and my liquidation threshold, now my LTV, which was already at, which is now about 85%. So now, my loan is not sufficiently over collateralized. The haircut on this is a lot lower than what it needs to be. So now market, what happens is my collateral, the deposit I made, becomes eligible for liquidation, meaning, because everyone's counterparty is the pool, right? So everyone is interacting with the protocol. So it's peer to protocol, everyone interacts with a smart contract. Borrowers interact with the smart contract. So smart contract, the pool is the counterparty for everyone, which means the counterparty needs to remain solvent at all times. So liquidation is how the solvency of the pool is maintained. So, market participants can borrow, can sell, essentially can buy, forgive me. So market participants can buy the collateral for, under collateralized positions or insufficiently collateralized positions at a 5% discount, right? So this is the liquidation penalty, as in if my collateral is now worth $90, somebody can buy it for 5% less. And that's how, so they're essentially exchanging the Bitcoin for something else. Now this borrow position, which was essentially under collateralized, is now, closed. There is sufficient liquidity in the pool. So when a depositor wants to redeem their funds, then the pool doesn't default, as in there is a way. This is how you sort of maintain the solvency, and we can come back when we have questions to some of these. So borrowing, again, pretty straightforward. You can see what assets are available for borrowing based on my collateral. It's USDC collateral, so there aren't that many choices here. If I switch my wallet to the hardware wallet, then I'll probably see a little bit. Yeah, so my dashboard, yeah, maybe Amm Market deposit now. Yeah, so I currently, I think, just hold on. Let's go back to the previous wallet. So borrowing is equally straightforward. You essentially just, I mean, if you have collateral in the pool, and it seems yeah, hold on. It looks like I don't have any in this wallet. So, but we can do that. Hold on. 25,000. Continue deposit. All right. 23.75 gas fees are at a historic low, so I'll deposit $25,000. And this is on the mainnet, so we're dealing with real money. It takes a little bit of time when you go on Etherscan, right? You can see the state of the transaction, and now it's done. So you can see that when I go to my dashboard, now I have $25,000 deposited, and on that I'm earning 2%. And the additional reward, which is quite something you see in DeFi, right? Which this idea of incentives for providing liquidity. So not only are you earning 2%, you're also able to earn 1.2% in staked Aave token. And so initially last year, the incentives were a pretty big deal in DeFi to really get new users. Now they are a lot less important as some of the protocols have matured and gained a lot of trust. So now if I want to borrow based on the collateral I posted, right? So which is $25,000 US, I can borrow, about 9.2 Ether. And yeah, and what I'm going to do is, the other thing I can do is I can borrow, so let's say 15,000 USDC. So yeah, let's do that. Borrow.
So
any questions at this point?
Ajit, there are quite a few questions here. So
sure.
So let's just start with the question that is relevant to this area. Why is there such a high LTV rate at this point? I mean, is it because your model works that way, or you configured your parameters accordingly? I mean, what is the reasons behind? I mean, if you could explain a little bit of the model, that would be interesting.
Sure. So if you go to, I just want to share the resources so that if there is more detail, you can check it yourself. So we have public risk docs, and these risk parameters are set based on the quality of the asset, first of all, because all you have is collateral. There is no other credit mitigation. The second thing is, so things that go into the risk assessment of a particular asset are things like how centralized or decentralized the asset is. So for example, Bitcoin is far more decentralized than BUSD, which is issued by an entity, Binance through Paxos. Then the level of volatility and maturity of the asset, Bitcoin has been around 12 years, right? Whereas some of the assets like Rai or even Aave are relatively new. So the LTVs on mature established assets generally tend to be higher. Then there are a bunch of other factors. For example, so the way this works is there is a decentralized governance process, right? So which means anyone can come up with a proposal and say things like, let's include Chainlink, right? Link as an asset that can be deposited. Then there is a voting process by which token holders can vote and decide if that's an acceptable proposal or not. And so the risk parameters are set as part of the open, transparent governance process. And increasingly that's now going forward, that will be governed by what we call a risk DAO, which will essentially which will be people independent of the Aave team, which will publish risk reports and risk assessments based on different assets, and then set the risk parameters, right? But ultimately, the key to solvency is liquidation, which means if the asset drops in value, then the collateral can be liquidated. And the Aave ecosystem is very active, so we have a number of market participants who are always sort of, standing ready to liquidate collateral if for positions that become under collateralized.
So in this situation, is it like, in terms of the token holders, I mean, how do we decide in the institutional side versus the retail side? Are the different token holders making those judgment calls on the risk parameters or the same? I mean, how do you decide on that? Because institutional, people may have different set of risk parameters versus retail. So how would those differentiated?
Absolutely. So I think the Aave permissionless, the environment does not distinguish between retail or institutional. I mean, ultimately everyone is just connecting with an Ethereum wallet, right? So when somebody creates a governance proposal, they will say things like add this algorithmic stablecoin RAI to Aave v2, right? And then there is an active voting process. So you can see that a lot of people didn't want it, and a lot of people actually did want it. And the team, the Aave team, the team that built the protocol and handed it off to the community was simply not involved, in the sense there is no voting by the team. There's so all of the token holders voted and decided that RAI should be added, right? And if you go into the details of this proposal, then you can see things like why it should be included. Oh, it's got 100 million in liquidity, it's got 300 million value locked. This is why it's such a good idea, and so on and so forth. So this is a very active process, which there's a lot of discussion on Discord, on Twitter, on Telegram, and various other channels. So very open, transparent type of discussion, and that ultimately there is voting, and then through the voting process, all the decisions are made. That's kind of how that's the decentralized part. Sorry, Sonia, you're on mute.
You're on mute, Sonia.
Okay. So the other question that you have from Mani is, Mani, do you want to ask? I mean, I don't want to be the one actually championing. Mani, go ahead.
Yeah. I know this is a little bit, the question is a little early enough, but can you discuss more about your private institutional lending pool and where we are with it at this point?
Yeah. So there was an email I had sent out to attendees of the webinar with Stani and Mike Novogratz and Michael Chalov, and that apparently ended up on Twitter, thanks to a very enthusiastic attendee. That happens in DeFi, and there's a lesson in there. So everything that it says is actually accurate, right? So it'll essentially be based on V2, the same secure, well-tested, robust code base that's been in the wild. What we are adding is a layer of permissioning, right? So because a lot of regulated entities and institutional market participants require liquidity or money only from KYC participants, right? So what will happen is an intermediary, which is basically regulated intermediary, basically Fireblocks, will KYB all the market participants, KYC all the market participants, onboard them, get the right T's and C's and disclosures in place. And essentially, it's a much simpler liquidity pool, as in you won't see as many assets, because all the institutional demand is in, most of the institutional demand is in Bitcoin, USDC, Ethereum, and very few other assets. So then, in addition to that, the risk parameters initially will be the same. We'll start on V2 based risk parameters. Then, if somebody wants, if market participants want to create a governance proposal and get Aave governance to change those risk parameters based on actual data, and they can start a proposal and get those changed. And then so it's basically the same as V2 with a much simpler asset profile. Essentially the same starting risk parameters and appropriate KYC and AML controls to meet the needs of institutional market participants. So that's kind of but it's still, I think the big idea here is that we are still working in a decentralized environment, right? So it's kind of this, and it's sort of building a bridge between where DeFi is currently and where DeFi can be in 10 years time or 5 years time as sort of new market infrastructure.
The only other question is privacy is still an issue there, right? Because all these others are public, so institutions are a bit wary to discuss or trade when their trading details are leaked out. It's very easy to track. How do you handle privacy here? I understand about the
Yeah. So I think, look, I mean, I wouldn't say we have solved everything, right? So we are solving one thing at a time. And with privacy, because we are not essentially, if we were building an automated market maker or a trading system, it would be a much bigger issue. It's still a consideration for many participants, for sure, right? So, but at the end of the day, the profile of the application is essentially, you deposit or you borrow, right? Now, it's possible for someone to see if, let's say a hedge fund has borrowed, 50 million out of the pool. Sure, they can see that, but there is not too much you can do with that, right? I mean, it's not that you can essentially trade against that very easily. Whereas if you were dealing with an automated market maker, and you can see that there is kind of liquidity, somebody has a particular position in an asset, then it's much easier to trade against that. And that's a whole other discussion with minor extractable value, or MEV, in the Ethereum space, because miners do tend to take advantage of, so that's another intermediation challenge. And the way this space works is, right, so when a lot of people sort of think of all the possible problems that can happen, right, and that's kind of the background I come from, right? So I worked in risk and compliance for a long time. So everything that could go wrong, and we never actually get started. So whereas in DeFi, if you listen to Market Reason, you solve one problem, then you solve the other problem, and layer by layer by layer, you kind of continuously innovate, and we don't have to go after the entire market. We are going after the market that's ready for it.
Thanks.
Sure. But we will. So there are a bunch of privacy protocols that we are looking at. Like Railgun is very interesting. Then there are, Aztec is very interesting. So you're absolutely right. Privacy will be a really, really big topic in DeFi going forward.
So Barry, since you have to have a hard stop at 11:30, would you like to ask anything? Because Barry's our Algorand guru here.
I was going to ask just one question, which is, I was just wondering, because I don't see a lot of altcoins listed as being on Aave. Are you seeing much in the way of demand for that? Not necessarily algo specific, but any of the quote unquote altcoins?
First of all, there are no altcoins. So as in altcoin we can have a separate discussion about the usage of that term. I mean, it works in a Bitcoin first environment, but from our perspective, all crypto assets are essentially competing for adoption. Now, most of the demand is in stable coins, right? So when you look at borrowing, because so part of this, there's a lot of demand for liquidity, for leverage in stable coins. So most of the borrowing activity is there, and most of the collateral that's used is typically Bitcoin, Ethereum, and a variety of other assets, right? So demand is kind of still quite concentrated in sort of the top of the coin gecko list. And then it's as they sort of and then as communities build up, and there's more liquidity in various assets, like Renfill, there's almost nothing there, right? And we spent a lot of time sort of figuring out whether Renfill should be in there or not. So different assets tend to have a different profile, but stable coins are dominant.
Well, I appreciate you not liking the term altcoin, but I happen to agree with it, but there's nothing I can do about that, since you and I are only two people in a world of millions. So
absolutely
not much I can do there.
Right.
Thank you very much for that.
Thank you, Barry. Nice to meet you.
Garrett had a few questions. Garrett, would you want to go ahead?
Yes, hi.
Garrett?
So what I was looking into is really, my focus now is trying to get this crypto digital asset world more meshed with, the securities markets in respect to hedge funds and them getting involved. And of course, for them to do that, they'll have to have some sort of portal where they can do that. And I see that this is the portal, but they'll also have to have some sort of, I guess, accounting team that'll make the transfer and do that for them. Now, it depends on where they're holding their assets, right? So if they're holding it, let's say they do have something at Coinbase, I don't know why, it's really expensive, but if they do that, then there's fees involved with that. So that's the first thing I wanted to talk about was, I guess you'd have to consider the fee structure of how that works with the transfers, and then also transfer out. When you transfer out, let's say I've completed my borrow and then I paid it back. how do I transfer that coin out? Is there a fee to do that?
Yeah. So I think one of the key things here is that the protocol is non-custodial. So you're essentially, when you're interacting with the smart contract, right? So before I start interacting, let me just show you here so that we can visually see what I'm talking about. So when I interact with the protocol, right? So you can see my transactions on MetaMask here. So initially, I'm starting with a wallet, which is typically a non-custodial wallet. So you can see that. So what I get in my wallet is a receipt token. It's kind of like so I've deposited 25,000 USDC. So the Aave protocol gives me a token, which is the Aave USDC token, right? Which is kind of like, hey, you have deposited. This is the proof token, and then the interest accrues in AUSDC, right? So with every Ethereum block, I earn more AUSDC, and each AUSDC is redeemable whenever I want for 1 USDC, right? So now, so just a couple of differences between here, how some of this infrastructure works. So first of all, there isn't a concept of custody, as in so I can custody a USDC token, and I have, so I have currently custody of a USDC token, but I can also interact with the protocol through a third-party wallet, which essentially, provides custody. But once you deposit the asset, then the control of the asset is with the smart contract, right? So the smart contract and sort of, who can move the asset? Right, and who can move the asset? The smart contract, or the keys corresponding to that smart contract can move the asset, which is why decentralization is quite important for security, right? Because I mean, if there is any, if let's say 80% of the token holders say, oh, let's gang up or let's collude and somehow move the assets to Sonia's address, then that's possible, right? And so which is a key risk in DeFi. And therefore, the decentralization sort of mitigates this risk, because if it's a truly widely distributed token holding pattern and it's very hard for people to collude, then the protocol is more secure. So when it comes to sort of how you interact with Coinbase is slightly different, in the sense that first of all, before you deposit your assets into Coinbase, you have you're a custodian, or you have custody. And then after that, you're essentially trusting Coinbase with the safekeeping of your assets, right? In this case, it's the smart contract that's playing that role.
Okay, and then another question really is, talking about the technology. So for where I am currently, I basically did the first integration with a company called CoinRoute, so that we can take the information into our portfolio management system, and our clients can manage risk, et cetera. Now, that also has to do with the ability for them to write a really good API, and I'm not going to make any commentary on that, because it takes you need some quality programmers to make a good API. And I was wondering, are you looking at that as well? Because I'm thinking eventually it's going to come to the point where I can go into, as a hedge fund, I can go into my OMS and create that, create that, I guess, stake through, let's say, Aave, and maintain a view of that position throughout, right?
Absolutely. So absolutely. So there are two ways to integrate with Aave. The first is through the Solidity codes, and the second is through the JavaScript API. So the smart contract addresses in the permissionless environment are accessible by anyone. In the permissioned environment that we are deploying, you will need to be KYC'd to be able, and whitelisted to be able to connect to those the smart contracts and invoke any other methods. JavaScript, so the JavaScript API is also quite straightforward. That's available. I mean, it's been, the APIs have been used quite actively, so I would think that they're pretty good. But yes, it's worth a look.
Yeah, because all the alerts that you could supply are quite important, obviously.
Absolutely. So token, the likes of Token Tax and various other third-party software providers do integrate to offer a variety of functions. Sorry, go ahead.
Okay, and I also can, as a hedge fund person, I can also, I borrowed coin to make transactions, and now I want to pay them back. I can pay them back early. You don't have a that contract can be paid back early, correct?
You can pay them back at any time.
Anytime.
Yeah,
Okay.
yeah. So at any time, right? So yeah.
All right.
So one of the things that's cool about DeFi, right, is this availability of open source analytics, Nansen, Aave. If I just Google for Nansen and Aave, right? So then you will typically find something or the other that says, I may actually have some bookmarks here. So yeah, so if you look at Dune Analytics here, so the Aave metrics are available. In real time. In real time, you can see how much the protocol is earning. You don't have to wait for a quarterly report, as with some centralized exchanges. You can see outstanding borrowing, what's the sort of risk position we are looking at, how many people are essentially supplying liquidity, and so on and so forth. So there are quite a few people who just go ahead and build, this was built by Matthew, who works for Uniswap now. And you will see, so some comparisons between protocols like Compound and Aave. You will see things, going back to daily volume. So there is, and none of this was done by us. So I think this level of, transparency, analytics, so there are some, when we think about this philosophically, right? So, I mean, right now, all of DeFi is approximately 85 to, depending on the day you're looking at it and how you're measuring it, somewhere around 80, 85 billion in TVL and about 150, 60 billion in liquidity overall. So it's kind of a rounding error in terms of the size of the US financial system, right? But in terms of when you sort of extrapolate this and dare to dream, and you say, okay, what if everything worked like this, right? Magically somehow. Then this type of transparency, automation, just the visibility of everything, will it increase systemic risk or reduce systemic risk? Right? My bet is having watched Lehman go down, is that it will reduce systemic risk. So I think in terms of some of these ideas are actually very powerful. The ability for everyone to essentially look at what's really going on and what the risk is.
Right. All right, and so one final question. Sorry to take up everybody's time, but Cindy asked a very important question earlier. I wanted to ask the same question, which is great mind things alike. But really, it's about reporting. So I need to get that data in a way that I can present it to to SEC or FINRA, et cetera. And so I'll need reports generated. Now I understand you'll probably have your own version of it, and that means that each company is going to have to figure out how to filter it out to get the right information. But do you offer any kind of reports, or will you be offering any kind of reporting?
No, I mean, at this, that's what I was saying, right? So it's possible for anyone, and like Dune Analytics could get into that business tomorrow, right? So which is, they want to generate accounting information. They don't need to ask us. That's the best part, right? I mean, there's no contract to be signed. We cannot take any commercial advantage of that discussion. It's as a team, it's just, people can just go ahead and build it. And if you have 4 good developers who want to do it themselves, they're very welcome to. But what will happen is, as this infrastructure gains adoption, right, you will have sort of software providers and whatnot. The whole ecosystem is starting to come around.
Okay, I will stop.
Accenture could do it, right?
So I'd like to give the floor. I mean, David is our crypto asset working group chair, and has actually introduced all of us to staking and DeFi. So David, I'm putting you in a spot. David, are you there?
He may not want to be put on the spot, Sonia.
He told me. Okay, fine. Go ahead, Ajit. I guess David would come back later. Go ahead.
Yeah. So I think one of the, let me just I want to show you something else, which is really something. So we innovate a lot. There is no moat in DeFi, as Danny says. So I mean, we can't be evil. So it's not, don't be evil. We just don't have any regular licenses that we can rely on, like banks, to protect a business. We don't have any software IP that we can send patent trolls after. So DeFi is just the only thing we can rely on is innovation and community. So those 2 things, and more and more the innovation has to come from the community, right? So which means if we only rely on the 40 odd people we have on the team, then we don't really have access to much talent. So Mark and Recent talks about, those are good people. but even me. But when you think about the availability of talent around the world and how much access we get to talent by essentially opening this up. So we essentially created this idea of delegating power. So you don't need to buy a lot of tokens. This is kind of the demo wallet. So you don't need to buy a lot of tokens to to essentially contribute to the protocol. You can get someone to delegate. So so any of the token holders can delegate proposition power or voting power, which is the power to either create a proposal or vote on a proposal to so what's this yeah, so I can so Sonia, if Sonia has a great idea or not so great, I mean, of course Sonia will have only great ideas, but if there are any ideas at all sorry, and you want us to any of the token holders to delegate the power, then you can do that, which means we get a lot of input from the folks at Berkeley, Stanford, Harvard, IITs, whatever. So that type of access to talent. And then we also created a grants program so that you don't need to. If back in the day, I had to get a job at Goldman to be at the bleeding edge of derivatives pricing. Now you don't have to do that. If you want to be at the bleeding edge of DeFi, you've got an idea, go build, right? And you can get a grant from the Aave DAO, and that's that permissionless innovation. As opposed to 5 guys sitting in a room making PowerPoints and then engaging in corporate politics. I've never done that, I promise you. But it's this type of permissionless innovation is truly
exactly
powerful,
what
right?
You're talking about. I know exactly what you're talking about.
So I think this is the big idea. So I find this idea of that Mark Andreessen talks about permissionless innovation even bigger than DeFi, right? How do you get more and more access to talent and really contributions from wherever in an environment that's truly meritocratic and open, and that's a pretty big deal.
Okay, so Ron, go ahead.
Thanks, Sonia. Hey, Ajit, thanks for all of that, and we can go on for hours. One of the questions I wanted to raise, and a lot of us on the call know Rebecca Reddig obviously well, and we have a lot of colleagues from the law space, from the accounting space, and I'm sure you're part of some of the conversations at Aave. Do you have any concerns from the regulatory or legislative perspective? What's happening in DC, the tone and tempo of understanding decentralized innovation and decentralized finance? I think there's a lot of work to happen with regulators and legislators, but I'd love kind of your overall perspective from Aave's point of view.
Yeah. So we are very proactive. Being with the brand and the community and the trust we have earned. We are in a privileged position to sort of proactively drive some of those conversations. So Rebecca has definitely been leading the charge in a lot of those conversations, and we have proactively reached out to multiple policy institutions and regulators, either directly or through groups like this one, or through Wall Street, through Blockchain Association and so on. Now, what's the overall view, right? It depends on who you ask. So there are some genuine concerns, right? So I mean, things around asset protection and consumer protection. Yep, there are some, of course, there are some valid concerns there in terms of, how does this ecosystem of innovation ensure that? There are certain, obviously, concerns around, but I think, there are people like, Commissioner Pierce and I mean, former OCC Chairman Brian Brooks and so on, who are sort of forward-looking, who are close to the space, and who understand what this can become. And then there are, obviously, individuals who are a little bit less close to the entire FinTech and DeFi space, and it takes a little bit more engagement, and that's what we're doing, right? So we sort of continue to engage, and we learn as much as we try to educate. So we've had conversations with the Bank of England that went really well. With the FCA, that went really well. So obviously, there's always this trade-off, or there's this tension between preserving how things work today. You heard the CFTC commissioners' views on, we need intermediaries. So there is always that perspective as well, right? This is how the system works. This is how the system should always work. And there are others who sort of look ahead and say, how can actually this work, right? And then what safeguards are needed to take advantage of the opportunity while sort of, balancing some of the risks. And that's an ongoing process. We don't have a final answer to that. I mean, we just continue to educate and engage.
Yeah.
But there are a variety of views. I mean, I can't, depending on who you ask, you get a different.
Yeah, and it's about the ongoing conversation.
Yeah,
with those
yeah.
players.
Yeah,
So
and we learn as much as we share.
yeah, appreciate it, Ajit. Thank you.
So Ajit, I mean, we both come from the derivative space, and how do you see this, in terms of how do you compare it to the derivatives world? I mean, do you see a lot of hedge fund clients looking at, so like I just spoke to a client this week, they're looking at Tether and the issues with Tether being, STO and, how to stake it. We were actually talking to them about that. How do you see them adopting this asset, as a hedging asset with the other asset classes, whether it's CDSs or interest rate swaps or a regular plain vanilla bond or plain vanilla equities? How do you see that adoption and the pain, because we all know the crisis that happened in 2008, we all went through it. Is this another looming crisis, or what do you say? Because you come from a similar kind of background. What's your perspective?
Yeah, I'll try and not give a reactive answer, right? I mean, but let me give you a 1 minute reactive answer. We live in the world of infinite money, according to Mr. Kashkari. And, so when it comes to creating a crisis, I think infinite money will do it by itself. We had Archegos, and that had nothing to do with DeFi or crypto or anything. And that was very recent. Okay, that's the reactive, that's the reactive revolutionary answer. Now, I think, so DeFi I don't believe DeFi is inventing new finance, right? So there are certain things like flash loans, which only this technology enables, but there are very, very few of those things. So there is some value in learning from, so the challenge for regulators, and I don't envy the job of, a regulator here, because how do we sort of apply all of the learning from Lehman, from savings and loan crises, from the commercial, breaking of the buck, and all of those wonderful events and the 400 years of everything that we have got wrong on Wall Street from time to time, while also supporting this innovation, this level of this pace of innovation? That's a hard problem, right? Now, I think that it's easy to err on the side of risk and say, oh, yeah, we don't care if nothing, let's just try and go to zero risk, right? But we never had zero risk. I mean, the level of systemic risk right now, with infinite money, excessive leverage, I mean, it's in the stock market is extraordinary, right? So, I think there's crypto. Everybody loves to talk about crypto, but crypto is such an isolated part of the market. I mean, most banks don't hold any crypto on their balance sheet. The financial system is still mostly isolated from Tether and USDC and everything. Sure, we have 50 billion, but how big is that number compared to everything else we're dealing with? So I think there is a loss of perspective when people talk about risk associated with stablecoins. Sure, if Tether breaks tomorrow, maybe Bitcoin will go to $15,000 or $10,000, but the rest of the financial system is pretty isolated, right? So I think some of the thinking that's going on from the Fed and the Bank of England around treating stablecoins as commercial bank money, and then essentially applying some of the learnings from the Bank Holding Company Act and stress testing is very valid. Now, the risk is we could apply all of the. Here is what's gone wrong, right? Sorry, I get emotional about this, and I used to work for an audit firm briefly. We have created so many rules for regulators create new rules. Those rules are written on paper. Wall Street goes ahead and breaks those rules, then we write more paper, right? That's just not going to work. So I think now that we have better technology, maybe we should regulate using better technology, right? And hopefully with DeFi, we can make that possible. Sorry, it's a slightly passionate speech, but I mean, we know that the system isn't working. So maybe let's use better technology to fix it.
Hey,
sorry, that was a bit of a tirade. My apologies.
That was
Money,
awesome.
go ahead.
You guys,
Sorry.
you guys hear me okay?
All
right.
I had to mute someone. I'm sorry. Go ahead, Sonia.
Money, go ahead.
How do you, approach the liquidity now? This fragmentation of the liquidity between multiple pools now, and is there something in the plan to address these in the future?
Yeah, so I think it's by design, right? So the way, I mean, we operate in a space where technology is still maturing. I mean, it's still early days. There are multiple EVM compatible chains. There are new blockchain protocols like Solana, Polkadot, and all these better, maybe better, maybe not. technology is coming up, and and it's still the 95 or year 2000 of the internet here. So we don't want to make the decision for the market, right? We're going to deploy on multiple EVM compatible chains. So we deployed on Polygon because there was a lot of demand from users for gas efficient deployment. We're going to deploy a permission version because there is clearly market demand for it, and that's we'll see if that's the general direction of the market. So we kind of recognize that we are operating in a highly evolutionary space, right? So which is why the design of the protocol supports. So we deployed V1, we deployed V2, right? Liquidity moved from V1 to V2. So and tomorrow it might just move from V2 to Polygon. Polygon grew from 0 to 7 billion in almost 30 days. Then it might all move to permission pools. So I think we're going to let the market kind of determine. Market forces determine this, but then there'll be different markets, right? And for example, there might be, so Amm Market, for example, right? So I didn't show you the Amm Market. So what it does is it uses Uniswap V2 LP liquidity pool tokens as collateral. Right, so there is a demand for borrowing against that asset, and that has a very unique risk profile. Now, if you want to, we are experimenting with non-fungible tokens as collateral. That's something we're going to do on its own initially, right? Before until we fully understand the risk profile, the oracles, market data that we have to build, the type of liquidations we have to build. So I think the design of the protocol is flexible, and you're right. But I think market forces will determine which pools have the highest liquidity.
You're on mute.
Sorry, Sonia, you're on mute.
Cindy, are you on mute?
Yes, I think Ajit already touched on some of that already. But I'm just wondering, what do you see DeFi evolving to? You mentioned that it's still in the early innings, right? And then what do you think the North Star could be for Aave?
We're looking at, we got to this place in 2 years. And before 2020, most people had never heard of DeFi. It was some usual Ethereum conference goers like me who had an idea what this is. I think it's too early to call. But we have a view on where we think this is going, and it's really about building, internet first infrastructure. Right. So, but applications will still be delivered by the likes of Revolut and other fintechs, right? So people will integrate and compose the different smart contracts and protocols into applications and serve them to consumers with appropriate controls and so on. So North Star is Netflix. North Star is Netflix, meaning in 1998, 99 they were talking about streaming, and it took until 2012 to really start streaming at scale. So we are in probably 1999, and we'll see what 2012 looks like. Hopefully this is how the entire financial system will work.
Ajit, what do you think about the Indian market? I know you have some investments in the Indian market, in the blockchain space, on the token space. How do you foresee that market evolving?
It's phenomenal. It's phenomenal. So much developer talent. Ultimately, there's just an incredible amount of developer talent that has come into crypto, and I called it a year ago. So I've kind of been, very well off for it. And there's a lot of, I think there is a lot of valid concern around, crypto trading activity and strange coins like Dogecoin and Shiba and whatnot amongst the Indian policymakers, and it's important to have some controls there. But in terms of India has had a good run in tech for a long time and just getting started in crypto, so pretty exciting, right? And this is global. So Aave has somebody in Dharamshala. We have an integration engineer in Dharamshala.
Wow.
That's somewhere in Himachal. Most people have never heard of the place, but Dalai Lama used to live there. So that's what we're talking about, right? This is the internet. So, nobody really cares if you're in India, so or in the US or whatever. It's pretty cool to be just have the right skills.
So you're seeing a lot of innovation in that side, and you're seeing a lot
of people investing. Yeah, it's truly beautiful. There's just an awful lot going on, and Stani has invested in the Indian ecosystem. DeFi Alliance launched an India chapter. So DeFi is just one aspect, right? The future of work part is something I really wanted to emphasize, which is, around NFTs and just so much going on. And I don't even know what's not going on, right? What's going on, right? So once I go to the developer conferences, I'll find out what I don't know. So, and that's happening globally, in a completely chaotic, creative, strange, internet-oriented way. And if you really want to get a feel for it, I would recommend a TV series called Halt and Catch Fire, right? So it's on Amazon Prime Video, Halt and Catch Fire. Now you take Halt and Catch Fire and put it on the internet 20 years later, it goes crazy. It's about the PC revolution and how the internet came about and whatnot. So it's important to think about DeFi from an internet perspective as opposed to a financial services perspective, because it's very hard to understand what's going on otherwise.
Okay, I believe you're very familiar with Max, right? I mean, you know Max in London, right? He just announced today that they started a bank. What do you think about that? I mean,
which bank?
In terms of, he started a new bank called 10 something. He just announced today. Max Cantella, the one. I think you guys. Okay. He's just announced.
Are they doing something with DeFi? Okay, I see. Yeah. So I wrote an article last year. I think crypto and fiat banking is getting integrated. PayPal was the big shot in that direction, which also means that some of the prudential rules, right? So right now everyone talks about KYC and AML, but nobody talks about capital reserves. And I see a question here from Genesis, which is perfectly well directed. So prudential rules will start to apply in crypto, and you will see this integration of the overall system. And then where does DeFi fit into that? We're going to find out. So we're just building backend infrastructure for FinTech, which is building the front end.
Okay.
Sorry, Ron.
Yes, Sonia, I'm sorry to interrupt. We have Mike from Blockchain Intelligence Group. He's actually on a phone, but I know he had a question. Mike, can you hear us?
Yeah, I'm good now. Can you guys hear me?
Yes, please go ahead.
Oh, I wanted to comment on, and it's sadly the ship may have sailed, but the comments as to correlating what we're talking about now, with DeFi with the financial crisis. I mean, back then we were dealing with a lot of predatory lending and things on the retail space, whereas I think with DeFi, unless you're dealing with institutions offering substantial leverage, I think that there's an inherent preventative measure, which is that people don't have that kind of funding just to throw into this, without a lot of understanding of the space. So I think that in and of itself, unless we're talking about substantial leverage offered, then it's not really apples to oranges or apples to apples.
Thank you, Mike.
So, Ajit, how would you like to summarize the whole DeFi market, and how would you leave the whole thing? I mean, how do you want us to think about Aave going forward?
Aave. So yeah, I mean, you think of us as product people and engineers really looking to build great technology. Aave is a software company, so we have and it's that the company creates essentially decentralized software, which is then handed off to token holders to essentially govern, grow, improve. And our goal is to build an innovation ecosystem where the community takes care of kind of everything and literally everything. So it's internet just in the same way, right? So now anyone can contribute to Ethereum. Aave is kind of one level above. It's a protocol for liquidity, and then it will have a bunch of innovations around it. And a lot of those innovations are coming not from the team, but from the broader community, and more and more will happen. So we just essentially sparked a fire. Stani and Jordan and the team have done a phenomenal job. So now it's we would love for everyone in this group to contribute to Aave governance. Come contribute ideas, get famous in the process as well. There is some upside there, and very popular. So yeah, so let's and it's worth doing. I think that's the best part. So it's truly innovative. There's a lot of exciting stuff going on, and innovation is never risk-free. We would never have landed on the moon, or we would not be flying if we wanted risk-free jumbo jets. So let's try and manage the risks while innovating. That's the punchline.
Yeah, and as a thank you, we'll ask Ron to send a letter to your wife how good you are, okay?
I am more than happy to, I'll send her a cameo video about how wonderful Ajit's presentation was. No, Ajit, this was absolutely wonderful. Sonia, any last comments? Ajit, we hope you come back, and how can people reach you if they wanted to reach out?
Yeah, so, Aave.com is our website. My Telegram handle is Chain Yoda, Twitter, Telegram, wherever you see this, the mark of Phantom.
Yoda.
The Yoda. So the Chain Yoda is kind of bad upside. Wherever you Google it, you'll find me. Thanks.
Yeah, Yoda is everywhere. So you guys
Excellent.
have to. Okay. Thank you very much.
It's been a
everybody, for
pleasure. Thank you
joining
so much for inviting us. Appreciate it.
us. Thank you.
Thanks,
Thank you,
Ajit.
Ajit.
Thank you.
Take care. We'll chat soon.
Likewise.
Thank you.